As investors, a frequent issue you may run into is when an actionable opportunity occurs right before an earnings release. Ideally, we want to buy stocks right as they move beyond their buy point or as they're breaking out. But sometimes the breakout is just one day before earnings are due. It can be especially tempting when we're seeing a stock acting just right. Fundamentals are top-notch, there's a compelling growth story, and the stock is in a bullish setup. So, what's the best course of action to take? While there are no hard and fast rules here, there are a few different strategies that you can use to help mitigate that pre-earnings release risk. First, you could seek to start a smaller position size, say a half or quarter position. Then, should the stock react positively on earnings, you can complete the position with a lower average cost than if you initiated the entire position post-earnings. On the other hand, if the stock sells off, then you can sell your small position and take less damage than you would have with a full position. Another strategy is to use options. IBD's option strategy allows investors to limit their risk around earnings. So, how does it work? The strategy offers a way to capitalize on a stock's upside potential following its earnings while reducing the risk of a negative reaction by limiting your downside. I know that trading options may sound a little complicated if you're not used to it, but this strategy is super simple and an important tool for individual investors to have in their back pocket. For this strategy, first we're going to want to look for stocks nearing a proper buy point. Then we'll look for a slightly out-of-the-money weekly or monthly call option. Calls give the buyer the right but not the obligation to buy a stock at an agreed-upon price known as the strike price, by an agreed-upon date known as the expiration date. With our options earning strategy, we're simply looking for a slightly out-of-the-money call option. Out of the money indicates the type of strike price we're looking for and indicates a strike that is just above the current underlying stock price. Now, every strike price comes with a premium, or the cost to the buyer for the option. Divide the premium by the stock's current price and multiply by 100. This gives you the downside risk for the trade in percentage form. For this earnings option strategy, we're ideally looking for trades with a downside risk of 4% or less. Let's look at an example to make this make sense. Let's look at NVIDIA back in May of 2016 using IBD's charting tools. Shares were trading around $35.50 on May 12th, so a slightly out-of-the-money weekly call with a 36 strike price and a May 13th expiration could have been purchased at a premium of $1.27. That offered a trade with a 3.6% downside risk. Shares gapped up on May 13th on earnings and closed at $40.98. The option could have been exercised that day at $36. $37.27 is the cost per share to execute the trade if you're factoring in what you paid in premium. Or if you didn't want shares, you could have sold the option itself for a nice profit. Now, it's important to note that earnings options plays aren't always going to work, but they're a lower risk alternative to buying a stock outright ahead of earnings because risk is predefined to the total premium you paid to own the option, which, in this case, was $1.27 per share per contract or $127 per call option contract. Remember, we're not looking to profit big off the option itself. The key intention is just to find a way to get into the stock with limited downside risk. It allows you to participate while capping your risk so you don't end up risking a 20% gap down should the reaction to earnings be bad.